What if I told you that the most important economic relationship shaping Africa today is not with Europe, not with the United States, but with China? And what if I told you this didn't happen through war, colonization, or conquest, but through ports, railways, loans, and quiet contracts? In just 2 decades, China went from being a minor player in Africa to becoming the continent's largest trading partner, with trade volume crossing $280 billion. That's not a coincidence. That's a strategy. But here's the real mystery. Why did African nations turn east instead of west? Why did China bet so heavily on Africa when others pulled back? And most importantly, is this partnership building Africa's future, or creating a new kind of dependence? The answers aren't simple, and they don't start in Africa. They start inside China itself. To understand this story, you need to zoom out to the late 1970s. China was poor, extremely poor. After decades of isolation and failed economic experiments, the country was struggling with low productivity, weak infrastructure, and limited access to global markets. Then came Deng Xiaoping. He launched economic reforms that opened China to foreign investment, export manufacturing, and market-driven growth. Factories exploded across the country. Cities expanded. Millions were lifted out of poverty. But success created a new problem. By the early 2000s, China had become the factory of the world, and factories need 3 things: raw materials, energy, new markets. China didn't have enough of any of them. Meanwhile, Africa was facing the opposite crisis. Many African countries were rich in resources: oil, copper, cobalt, iron ore, rare earths, but poor in infrastructure, capital, and industrial capacity. Roads were broken, power grids were weak, ports were outdated. Western investors saw Africa as risky, so Africa had resources without money. China had money without resources. That imbalance created the perfect opening. But this partnership didn't begin with billion-dollar deals. It began quietly. China's relationship with Africa actually goes back to the Cold War. In the 1960s and 70s, China supported African liberation movements as a way to gain diplomatic allies against Western powers and the Soviet Union. One of the earliest symbols of this was the Tanzania-Zambia Railway, built by China in the 1970s. At the time it looked ideological, but decades later China revived this relationship with a new goal: economics. In 2000, Beijing launched the Forum on China-Africa Cooperation (FOCAC). This was the turning point. FOCAC wasn't just about speeches. It created trade agreements, loan frameworks, infrastructure partnerships, investment pipelines. Instead of demanding political reforms or governance conditions, China offered something African leaders desperately wanted: speed. Western development loans came with long approval processes, transparency requirements, and political conditions. China offered fast financing, rapid construction, and bundled deals. Build a highway, construct a port, upgrade a power plant. In exchange, long-term resource contracts and trade access. This wasn't charity. It was calculated economic diplomacy. China understood something Western institutions ignored. You cannot industrialize without infrastructure. So Beijing focused on what it did best: construction. Chinese companies flooded into Africa, building railways in Kenya and Ethiopia, ports in Djibouti and Tanzania, dams in Angola and Sudan, roads across West Africa, telecom networks in dozens of countries. These projects served 2 purposes. First, they created jobs and visible development in African countries. Second, they locked Chinese firms into long-term operational roles. When China builds your port, it often also manages it. When China builds your railway, it supplies the trains. When China builds your power plant, it sells the equipment. Infrastructure became a doorway into permanent economic presence. And while this was happening, trade volumes started exploding. In the year 2000, China-Africa trade was roughly $10 billion. By 2010, it crossed $100 billion. Africa exported oil from Angola and Nigeria, copper from Zambia, cobalt from the Congo, iron ore from South Africa, agricultural goods across the continent. China exported machinery, electronics, vehicles, construction equipment, consumer goods. This created a powerful cycle. African raw materials fed Chinese factories. Chinese factories produced goods sold back to Africa. Chinese infrastructure projects expanded transport routes. More trade became possible. It looked like mutual growth. But beneath this success story, structural imbalances were forming, and they would soon become controversial. This wasn't accidental. It was guided by top-level policy. Chinese presidents from Hu Jintao to Xi Jinping personally prioritized Africa diplomacy. High-level summits became routine. Massive state-owned enterprises were encouraged to expand abroad under China's going-out strategy. Banks like China Exim Bank, China Development Bank became financial weapons of expansion. They offered low-interest loans tied to Chinese contractors. This meant African governments got funding, but Chinese companies got the projects. It was a closed-loop system. Money flowed from Chinese banks, gives to African governments, gives back to Chinese firms, gives into Chinese employment and manufacturing. Africa got infrastructure. China got influence. Everyone seemed to win, at least on the surface. By the mid-2010s, cracks started appearing. Some African nations had borrowed heavily to fund infrastructure. Debt levels climbed. Revenue projections failed to match expectations. Commodity prices fluctuated. At the same time, critics began asking uncomfortable questions. Why are African exports mostly raw materials? Why are value-added industries still underdeveloped? Why are Chinese imports dominating local markets? Local manufacturers struggled to compete with cheap Chinese goods. Trade balances tilted heavily in China's favor. And then came the phrase that changed the narrative: debt trap diplomacy. Was China intentionally lending too much to gain political leverage? Or was Africa simply taking on unsustainable loans? The truth is complicated. But what's clear is this: the partnership had reached a breaking point, and that breaking point would expose the real power dynamics behind the $280 billion trade empire. By the late 2010s, the honeymoon phase of China-Africa economic cooperation was over. Railways had been built, ports had expanded, power stations were online, trade volumes were higher than ever. On paper it looked like a success story, but behind closed doors, finance ministries across Africa were facing a different reality. Loan repayment schedules were arriving, commodity prices were volatile, COVID-19 would soon crash government revenues, and many of the infrastructure projects were not generating enough profit to cover their debt. This is when the headlines exploded. China debt trap in Africa. Beijing seizing ports. New colonialism. But reality was more complex than the headlines suggested. Let's break it down. Contrary to popular belief, China did not suddenly start confiscating African assets en masse. Instead, what happened was quieter and arguably more strategic. When countries like Zambia, Ethiopia, Kenya, and Angola faced repayment difficulties, Beijing rarely demanded immediate seizures. Instead, China renegotiated. It offered payment extensions, interest rate reductions, debt restructuring, currency swaps, project refinancing. Why? Because China's goal was not short-term profit, it was long-term influence. By keeping countries financially dependent, China maintained leverage over trade policy, diplomatic alignment, infrastructure access, strategic locations. In global politics, dependency creates power, and Africa, with its growing population, natural resources, and voting influence in international organizations, was too valuable to abandon. But this strategy created backlash. Across Africa, citizens and opposition parties began questioning Chinese projects. In Kenya, the massive standard gauge railway became controversial due to its cost and debt burden. In Zambia, concerns over sovereignty fueled election campaigns. In Ghana and Nigeria, labor unions criticized Chinese companies for hiring practices and wage policies. People started asking, why are local workers not being trained fast enough? Why are profits flowing outward? Why are African exports still dominated by raw materials? This marked a turning point. African leaders realized that simply building infrastructure was not enough. Development without industrialization creates dependency, not prosperity. And China realized something too. Its original strategy needed to evolve. Around 2018 to 2020, Beijing quietly changed its Africa policy. Instead of focusing only on construction and loans, China began emphasizing manufacturing investment, industrial parks, technology transfer, local production, green energy projects. Why the shift? Because China itself was changing. Wages inside China were rising. Environmental regulations were tightening. Factories were becoming expensive to operate. Africa offered an alternative. Lower labor costs, growing consumer markets, strategic trade routes. This created a new phase. China exporting its manufacturing capacity into Africa. Chinese firms began setting up textile factories in Ethiopia, electronics assembly plants in Rwanda, vehicle production in Nigeria, battery material processing in the Congo. The goal was no longer just trading with Africa, it was building production inside Africa. As China deepened its presence, Western nations took notice. For decades, Europe and the United States had dominated African trade and influence. Suddenly, China was building ports, controlling logistics routes, financing governance, and shaping supply chains. This triggered a geopolitical response. The US launched infrastructure initiatives. The EU announced global gateway programs. Japan and India expanded African investment. Africa became the new battlefield of economic diplomacy, not with weapons, but with loans, factories, and fiber optic cables. Why? Because Africa's future matters more than ever. By 2050, Africa will have over 2.5 billion people, the world's youngest workforce, massive mineral reserves for green energy and batteries, growing urban consumer markets. Whoever builds Africa's supply chains today controls tomorrow's global economy. China understood this early. And that's why the $280 billion trade relationship is not just about commerce. It's about positioning. If this story sounds familiar, it should. In the 19th century, European powers built railways in Africa, not to help Africans, but to extract resources faster. Trade increased, infrastructure expanded, but industrial control stayed external. Today's situation is more complex and less brutal, but the structural risks remain. When a country exports raw materials and imports finished goods, wealth flows outward. When foreign companies control logistics and manufacturing, value stays abroad. Without strong local industries, Africa risks repeating a familiar cycle. Resource extraction gives export dependency, gives limited industrialization, gives long-term vulnerability. China's model is not colonial in the traditional sense. But economic dominance does not require flags or soldiers. It requires leverage. Let's put the scale into perspective. China now trades more with Africa than the US and EU combined in many years. Over 10,000 Chinese firms operate across the continent. Chinese companies have built more than 40% of Africa's major infrastructure projects. China controls or operates key ports across East and West Africa. Chinese telecom firms power a large portion of Africa's digital backbone. This isn't accidental. It's strategic positioning across transport, energy, data, and trade routes. And once these systems are built, reversing them becomes extremely difficult. Many African governments tried to rebalance the relationship. They introduced local content laws, import restrictions, manufacturing incentives, joint venture requirements. Some progress was made. But structural problems remained. Why? Because infrastructure alone does not create industrial ecosystems. You need skilled labor, reliable electricity, stable regulation, access to capital, regional trade integration. Without these foundations, foreign companies dominate high-value production. China offered tools, but African governments often lacked institutional capacity to fully control outcomes. This created uneven development. Some countries benefited more than others. Some projects succeeded. Others became expansive monuments to poor planning. Today, China-Africa relations are entering a new phase. Loans are slowing, equity investments are increasing, manufacturing is expanding, digital infrastructure is growing. At the same time, African nations are becoming more assertive. They are demanding technology transfer, local ownership, fairer trade terms, regional industrialization. The power dynamic is no longer one-sided. Africa has options now. China is no longer the only partner, and that changes everything. 3 key takeaways. Let's distill this entire story into 3 powerful lessons. 1. China didn't conquer Africa, it invested strategically. Infrastructure, finance, and trade replaced military power as tools of influence. 2. Trade growth does not automatically equal development. Without industrial control, countries can grow richer on paper while remaining structurally dependent. 3. Africa's future is not fixed. The same partnership that created dependency can also fuel industrial transformation if managed wisely. Africa now stands at a crossroads. One path leads to continued resource export and external dependence. The other leads to manufacturing, value creation, and economic sovereignty. China will continue to pursue its interests. So will the West. The real question is not what China wants. The real question is, what will Africa choose to become? The $280 billion trade relationship is not just a statistic. It is a mirror reflecting how modern power works. Not through war, not through colonization, but through contracts, ports, factories, and supply chains. And the decisions made today will shape global power for the next 50 years. If this video helped you understand the real forces shaping global economics, hit like to support deep analysis content. Subscribe for more geopolitics, finance, and hidden economic stories. And comment below. Do you think China's role in Africa is more opportunity or more risk? Your perspective matters.